Good morning. I too want to welcome you today and thank you for coming. It's great to see so much interest in Local Law 97. And I think today is going to be a great day. I know for me, this morning started out really great. As I was walking here, I was taking in all of the buildings as I passed them. And we know intuitively they're all so different, but it's really another thing to actually see them and get out of the office every once in a while. So we have a lot to cover today. And my goal for today is that you leave here having learned something that you didn't know before. So we have a lot to cover. Let's jump in. So, as you may or may not know, buildings account for about 2/3 of the greenhouse gas emissions in New York City. And the Local Law 97 was part of the Climate Mobilization Act, which aligns with both with the state, the federal, and also international climate agendas. It also aligns with New York City's goal of achieving zero emissions by 2050. And building performance standards are driving markets across the US. So if I can call your attention to the graph on the right, what you will see is our baseline year of 2005, and you will see some of the earlier sustainability laws and the phasing out of the oil that was mentioned earlier is the first part of the curve, leading us to the present day where you see a very sharp decline. That's Local Law 97's first phase, and then continuing with the upcoming phases through 2050 where we proceed to the goal of achieving zero emissions by 2050. I want to draw your attention to the timeline. So Local Law 97 covers buildings that exceed 25,000 gross square feet. They account for differing building types. Also, pursuant to the law, are 2 or more buildings on the same tax lot that together exceed 50,000 square feet, or 2 or more condominium buildings governed by the same board of managers and together exceed 50,000 square feet. So something that I do want to bring your attention to is the when the buildings on a BBL are together meet the 50,000 square foot threshold, the buildings, unlike the earlier laws, are subject to comply on the building level. Even though on the covered buildings list, they may be on the BBL level, these buildings are complying on the bin level. So if you look at the timeline above, it starts out when the law passed in 2019, and shortly after which the advisory board was formed and an adjustment program was launched, followed by the advisory board report at the end of 2023. And then we come into the first portion of the law taking effect in 2024 and the first compliance period, and followed by the successive compliance periods where the emissions limits get stricter and stricter. So I mentioned the advisory board. The advisory board began in November of 2019 when the board was appointed by the city council and the mayor. There were 7 working groups that made up the advisory board, and those were from representatives of the multifamily building sector, commercial buildings. There was a working group that met on carbon accounting, the energy grid, how to handle communications, economic impact, and also a group that met on hospitals. In total, there were 363 meetings, including 19 advisory board meetings. The advisory board report, as I mentioned, was published in December 2022. I'll call your attention to the right. That's the report. You can find it on the DOB website, and you can read it at your leisure. That report contained 30 recommendations that were proposed for the law. Several of these recommendations were implemented already, and then there are others that are still being studied, and then there will be some that will not move forward because the law doesn't give us the authority to do so. So, Local Law 97 falls into several different compliance buckets. What you might hear us refer to is Article 320 and Article 321. When I say that, what I'm referring to is the section of the Administrative Code. So Article 320 buildings make up the lion's share of the buildings that are subject to the law. Those are the private sector, non-rent regulated buildings. I will come back to that too. These buildings have to comply with the emissions limits, and they are allowed to purchase RECs when they're available and or offsets. For compliance for most of these buildings begins in this year, 2024, with penalties beginning in next year after the reports are due in May. There are two sets of buildings that fall under here. There are buildings that have a 2-year delay that are for less than 35% rent regulated buildings. And there is also another set that has a 10-year delay for income restricted buildings. So those buildings are considered Article 320 buildings, and you should be aware of those two sets of buildings. Next, we move to the Article 321 buildings. Those buildings are the rent-regulated accommodations that are greater than 35% rent-regulated and the houses of worship. Those buildings have two pathways for compliance, and we'll discuss those a little bit more later on. They must either show us that they meet the 2030 emissions limits now, or they can implement the list of 13 prescriptive energy conservation measures. And we will also discuss those as well. So for these buildings, this is a one-time compliance in 2025. For the 320 buildings, it is an annual compliance. There's a third tranche of buildings that some don't really realize that are subject to Local Law 97. Those buildings are the city buildings and the NYCHA buildings. And they actually have stricter limits than the 320 and 321 buildings, and they are on a different schedule, and they comply on a portfolio-wide basis. So one of the things that you should acquaint yourself with is where to find the covered building list and how to use it. So on the DOB website, what you will see currently are several different lists. So the first list are all buildings, and what you see on the right is part of the covered buildings matrix, and it tells you what pathway those buildings are subject to. The second pathway is for the 2026 compliance buildings, and the third is for the 2035 compliance buildings. Those were the two sets of buildings that are under Article 320 that I mentioned before. That are rent regulated, and the last set of buildings are the Article 321 buildings. So again, I mentioned on the DOB website, you can find the covered buildings list, and you can find the CBL matrix, which will show you what compliance pathway that your building should be following. The DOB cannot tell you what compliance pathway you are certainly on because of certain things. First of all, there may be circumstances that we are not aware of that need to be corroborated by a registered design professional, and that is why it is required for you to work with an RDP to submit your report to the department. Additionally, there could be changes in the circumstances of a building that we aren't aware of. So moving on to reporting and its extension requests. The annual report is due by May 1st each year, and it covers the preceding calendar year. So for 2024's compliance, you must submit that report by May 1st, 2025. There is an automatic grace period that is built in through June 30th, where you can submit a report without penalty. However, those reports that are submitted after June 30th will receive a 50-cent per square foot penalty for each month that passes after May 1st. If there is a non-compliant report that is submitted after the June 30th grace period, and that building is not pursuing penalty mitigation, it will incur fines for both late submission and for non-compliance. So if there's anything that you take away from today's presentation, what you should note is to get your reports in on time. The annual deadline extension requests may be submitted until June 30th, and they are allowed for 2 reasons. The first is that the registered design professional that you are working with cannot finish the report by August 29th, and they need until August 29th to finish it. And this has to be for certain reasons, like, for example, if they cannot get the utility provided data. But you have to have hired that professional prior to February 1st. So you cannot come to the department and say that on April 30th you hired an RDP and they can't finish the work on time. The second reason is that you are disputing with DOF that the building's recorded gross square footage and therefore the presence on the covered building list is in motion and you haven't received a decision yet. So moving on to more about the building level compliance, the submission of the reports and the penalties are at a building level, unlike prior sustainability local laws. This is by BIN, or what is referred to as a building identification number, so it's per building, even though on the covered buildings list, the property is listed by their borough block and lot. The eligibility for an adjustment and the exceptions does apply only to each individual building, not to the entire lot. So please be aware of that. The building level compliance is based on building level emissions calculations, and it's required even when there's a combined report that's submitted for 2 or more Article 320 buildings that are on a single lot, or adjacent lots owned by the same owner. The aggregated emissions calculation in a combined report is allowed only when all the buildings in the combined report share energy systems. And we'll go into what that means a little bit later as well. One thing you want to take note of is that all the existing buildings in New York City should have a bin. And you can verify this looking at the GOAT online database. If a bin doesn't have an address range, you cannot use it for a DOB filing. So this is one of the things that as an RDP or as a building owner hiring an RDP, you want to make sure you are looking into for all of the buildings on your lot. You would have to submit this through the Borough Topo Bureau, and then that approval would have to go to city planning, and that could take some time, so I urge you to look at that as one of the first things that you take on. Okay, so if you have multiple buildings on one lot, and I did get this question this morning, if there is a building on a lot that's greater than 25,000 gross square feet, then that entire lot gets put on the CBL. Even when the aggregate gross square footage for all of the buildings on that lot is less than 50,000. So in this case, you'll see 3 buildings, and the first building, building number 1, is 25,000 gross square feet, but the other buildings are 10,000 and 10,000. In this case, the aggregate gross square footage for the 3 buildings together is 46,000 square feet. That's less than the threshold of 50,000, which means that while building 1 is 25,000 gross square feet and it is required to report, building 2 and building 3 are not. Let's take this a similar scenario. If you have 3 buildings again, the first one is 25,000 square feet, but building 2 and building 3 are still less than 25, they're 10 and 15. You have an aggregate square footage of 51,000 square feet. I'm sorry, building 1 was 26,000. So 26,000 plus the 15 plus the 10, the aggregate square footage is 51,000, which is greater than 50,000 square feet, which means that all 3 buildings must report their emissions. I mentioned combined reports. A combined report may be submitted for 2 or more buildings in a single lot or adjacent lots, only if all the buildings in the combined report are owned by the same building owner and they're following the same compliance pathway. So each building in a combined report has to demonstrate building level compliance based on building level emissions calculations. However, if 2 or more buildings in the combined report share an energy service, they may demonstrate aggregate compliance based on the aggregate emissions calculations. So when you're looking at this example, you have 4 buildings on the lot. The first building is an Article 320 building that has 1 compliance pathway. Building 2 at the bottom is an exception because it's a city-owned building by the Cultural Institutions Group, so that is not covered. The other 2 buildings are both following Article 321. Note that those 2 buildings are Article 321, the other building is Article 320. All of these have to comply, except for building 2, but building 3 and building 4 are following the same pathway, and in this situation, they're sharing an energy service, so they can be 1 combined report, and they can submit as an aggregate emissions calculation. We spoke about shared energy service. So when the buildings share an energy service, that total consumption of every shared energy type must be mathematically apportioned among each building in the group. And the methodology for this apportioning would come from the RDP, and it must apply for all buildings within the group. The buildings are considered to share the energy service if one type is shared while the others are individually metered. So for in this example, building 1 and 2, each has their own electricity meter, but they are sharing 1 meter for their natural gas. So they would submit a shared, they are sharing an energy service. These 2 information resources you should become very familiar with. They're excellent resources that will give you a lot of information and answer a lot of the questions that you might have. The first one is the Article 320 Info Guide. Article 320 is, the information is in Rule 103.14, and what the Info Guide does is takes all of that information that's in the rule, and it really breaks it down for you in easy to understand language, and will answer a lot of the questions that you have. Similarly for Article 321, which is part of 103.17, that breaks down that rule, and it also on our these are both on our website, on the DOB Sustainability website, and it gives you both the filing guide for Article 321 as well as templates for the 4 measures that must be documented. So each building will have a GHG limit associated with it. And it's based on the different property types that are within the spaces in the building. So each GHG limit is a product of the gross floor area times the emissions factor for that space type. And in Rule 103.14, it defines the building emissions intensity limit, You can see that table on the right. It will give you the limits for the 2024 to 2029 compliance period for the different Energy Star Portfolio Manager space types. And it's based on 62 Energy Star Portfolio Manager or ESPM space types, and that is in Rule 103.14. On the other side of the equation, what you have is the GHG emissions, the annual emissions. So for each utility type, you will have a coefficient that's assigned to it. And just as the space limits will change over the different compliance periods, so will the coefficients. And below it is just the same material, but that's the way that you can see it in the rule. So, taking an example, if you had 3 different space uses in your building, you would take the gross floor area of the first space type, A, and you would multiply it by the emissions factor A, and similarly for B and C, and you would take the summation of all of that, and that would be what your emissions limit is for your total building. On the other side of the equation would be your coefficients for your fuel usage, for your actual emissions. So you would take your annual fuel usage of fuel W, and you would multiply it by the energy coefficient for fuel W. Same thing for Y and Z. You would sum that up, and that's on the other side of the equation. And then you would compare the two sides. So if your GHG emissions limit is greater than your annual GHG emissions, the building is in compliance. If, however, it is not, you would take the difference between those two, and you would multiply that by $268 per ton. And that would be your penalty. There are a lot of questions about gross floor area and gross square footage. Gross square footage is what the Department of Finance works with, and that is solely used by DOB for Local Law 97 in terms of the determining whether or not a building is on the covered buildings list or subject to the law. The gross floor area is measured and verified by the RDP, and that is what is used to determine the building's emissions limit. In general, that is going to be larger than the gross square footage by the Department of Finance. A lot of questions come in about, will we be reporting this to the Department of Finance and will our taxes go up? That's not what's going to happen. That is not the case. That's not what we use it for. Okay, so the definition of gross floor area, which is in Rule 103.14, is virtually the same as what you would find in the benchmarking law, Local Law 84, in Rule 103.06, and it aligns with ASHRAE publications for that definition as well. And it includes all above and below grade square footage within the enclosing walls of a building, as measured to the exterior surface of any of the architectural features. And every ESPM property type or space type on a floor is going to have its own aggregate gross floor area, and that is the boundary between those types should be taken at the center line of the demising walls. A lot of questions come in for us for the ancillary spaces, the stairwells, the corridors, the mechanical rooms, and how do you do space types for these, and what emissions limit do you apportion to these? And the way to do this is determined by the RDP, but you can do it based on square footage, on the floor area, or you can do it based on the emissions limits. Let's talk about deductions. A question came up this morning about an EV charging station at a building. In this case, where an EV charging station is at a building and it's causing that building's electric usage to look higher than what the building is actually using, This is allowed to be deducted from reported emissions. And there is a bulletin on that, which is on our website. You can read the bulletin as well, but you see it here. Those emissions are deducted. There are also deductions for on-site energy storage and beneficial electrification, and those are taken against the total emissions, while others, the renewable energy credits and on-site solar, are taken against the metered electricity that is used at the building before it's converted to an emissions amount. So the deductions from the on-site distributed energy resources are described in 103.14, and then the RECs are also addressed in the rule, and we have a department RECs FAQ on our website, and there more than likely will be possible future revisions as more RECs, as the RECs become available. And these deductions for the RECs are taken against the emissions resulting, this is important, from electricity consumption only, and not against emissions that are resulting from the combustion of any fossil fuels. So let's talk about beneficial electrification. Owners that replace fossil fuel equipment with high efficiency space conditioning or water heating equipment will receive a credit, and that is a negative credit based upon the year of installation and operation. So anything that is installed and operated prior to 2027 will get double the credit. And what this is showing you is the credit for electricity in the negative amount doubled for those earlier installations. And then after 2027, between 2027 and 2029, that credit is a one-for-one credit. So what if you don't need that credit because you are already in compliance? You can bank that credit for future years. So remember again that the beneficial electrification credit is twice as large for the equipment installed prior to 2027, and that's where you see in this chart, it's the darker area. And you're also, because of the early installation, you can use it over more years, any 6 years between 2024 and 2036. That decreases every year, obviously, because the years move on. And so that's the final year, which it can be generated, is 2029. So this is what everyone concerns themselves with, the enforcement. Basically, if your building is non-compliant, the DOB issues a notice of violation with the full penalty amount, and you have two choices. You can pay the penalty, or you can go to court for adjudication. The other way is that you can enter into mediated resolution with the department. And for qualifying buildings, DOB will enter into a legally binding agreement with the building owner. You would then submit your future building emissions reports showing that you're meeting your obligations. If you do not, however, it reverts back to DOB issuing the notice of violation. And I just want to make sure that people understand that the DOB can go back and issue back penalties based on non-compliance. So there is something called a good faith effort. So the way the penalties work is if you do not submit your report, which we talked about before, all of us are going to make sure that we submit our report on time, because that is a more substantial fine. That's 50 cents per square foot per month. And the fine for not meeting the emissions limits is the difference between your limit and what you're emitting times $268 per ton, and that's an annual fine. If, however, you enter into mediation with the department, there are ways that you can mitigate the penalties. There is unexpected or an unforeseeable event, tidal wave, fire, these things happen. And then the other thing is, if you enter into good faith effort, there are things that you need to do. On the left side, it shows that you have to submit your building emissions report, you have to have completed your benchmarking, and you have to have completed your local law 88 filing. When you've done all of those things, you have to also do one of the things on the right. So you can submit a decarbonization plan, you can submit a complete application for work that's already been approved by the DOB. You can show that you're building out for electrification readiness. You can show previous compliance with the emissions limits in prior years. You can prove that you're a critical facility, or you can have applied for the 320.7 adjustment. And what this is showing is a little bit more about the decarbonization plan. The decarb plan, if you're a larger building, more than equal to or greater than 50,000 square feet, it does require a level 2 energy audit. If you are a smaller building, less than 50,000 square feet, you are required to do a level 1 energy audit. And then there is a new document that we want to call your attention to, the GHG emissions reduction audit. This was published by DOE to expand the energy audit that's described in ASHRAE 211, which is required for local law 87, into a decarb audit. So please consult those references. They are good for you to take a look at. And now let's move on to our third proposed rule package that was recently released. It talks about offsets and the Affordable Housing Reinvestment Fund that's been mentioned earlier today, the 320.7 adjustments for external and financial constraints, biofuels, cogen, the fees, and the correction of an equipment in a prior rule package. So for the offset requirements, the law does allow for offsets for the use of 10% of a building's annual emissions limit. They have to be measured in metric tons of carbon dioxide equivalent, purchased, publicly registered and retired, and exhibit environmental integrity principles. So the way that this works is if you are at 90% or more of towards your way to being in compliance, you can satisfy 10% of your emissions or up to 10% of your emissions limit with the use of offsets. And they are purchased at $268 per ton. And they are put into an affordable housing investment fund, which then goes to fund electrification projects at 321 buildings and buildings that are under 25,000 square feet. The fund is administered by a third-party administrator, and the purchaser pays the $268 per ton to the fund. They receive a receipt that they then use for compliance for Local Law 97. It's recorded, and the funds are funneled to an HPD project in a registry, and the offset is retired in that registry. These funds are distributed through an already existing program called the READY program, and at the project closing, these projects, the emissions reduction is verified by an independent third-party verifier, and the registry is updated with the actual emissions that have been reduced. Buying the offset will allow your building to be in compliance. So for the 320 adjustment, We mentioned that earlier on the timeline, we saw that there were other adjustments for buildings that were more than 40% over their limit, and also for hospitals and for hospitals and healthcare facilities. There is another adjustment that is allowed via the law, and that is for buildings that are experiencing an external constraint imposed by, say, another provision of law or a physical condition of the building. We would need a description of the constraint and basically everything that has been done to achieve compliance outside of those things. And that adjustment would be good for 3 years. Additionally, you can get an adjustment based on a financial constraint, and that is for 1 year. There's qualifying standards for co-ops and condos, nonprofits, affordable housing, or no debt buildings, and as well as all other buildings. And that requires that these buildings are on the New York City annual tax lien list. To apply for these adjustments, you have to submit proof that the building has availed itself of incentives, aka you need to be working with New York City Accelerator, and you have to prove that the building has purchased the maximum amount of offsets that are available and RECs if available. So this slide is showing you the standard that must be met for the type of building. So for co-ops and condos, the annual cost for the owners, you have to show that it's gone up an average of 5% above the rate of inflation over the prior 3 years. For nonprofits, you must show that there's been negative revenue, less expenses for the prior 2 years. For buildings with an affordable housing regulatory agreement or no debt buildings, the standard to be met is that the income expense ratio has to be less than 1.05. And for all other buildings, the debt service coverage ratio has to be less than 1.15. In the proposed rule package is also the definition of a biofuel. That is defined as meaning biodiesel and renewable diesel. It also adds a carbon coefficient for biofuels, which aligns with the EPA standard. That's the coefficient in the first bullet, and it's basically comparable to that of fuel oil, and it streamlines the coefficient for standard biofuels. It does preserve the ability for a building owner to propose a coefficient for any unique fuel type for DOB to review. So for legacy cogeneration units, there are proposed alternative GHG coefficients. So there's 3 criteria that must be met. There has to be a minimum operating efficiency, which means it has to be as efficient or better than the current electric grid. It has to have a maximum NOx limit, which is set to the thresholds of recent incentive programs, and it has to have been in existence prior to September 1st, 2024. So that's why it is for legacy cogeneration. Additionally, there are specific exceptions for qualifying systems, a cogen serving a critical facility like a hospital, or in areas that are designated by DOB as unreliable or inadequate having inadequate grid generation capacity as verified by Con Edison. And it's felt that this allows a coefficient for grid electricity and steam to be used in lieu of gas for these cogeneration units. It eliminates a burden for these systems, but only for as long as they are producing electricity that is cleaner than what the grid can produce. And this methodology also phases out by the second compliance period, or 2030, based upon renewables entering the grid. The latest set of proposed rules also lays out the fees for the different reporting and for Local Law 88. It also characterizes them differently for simple reports and complex reports, also for reports that are requiring, are proposing that they are entering into a good faith effort. And then other reports as indicated above. And then the bottom is showing you the adjustment application fees for external constraints and financial constraints. So we also want to talk about the reporting portal. We get a ton of questions about, what does this look like? What are we going to have to report? So we've entered, we are working with a program called the Building Energy Analysis Manager, or BEAM. So we refer to it as the BEAM platform. That's where all future compliance submissions will be reported. Any emissions reports for Article 320 and Article 321, as well as the adjustment applications. This platform will have access to the EPA's ESPM portal, and as well as our DOB's DOB Now portal, where you will pay the filing fees as well as the payment of any penalties. The platform will be designed so that it automates most of the calculations that are input by the registered design professional. There will be templates that will be provided for the deductions and the credits, and it allows the owners and service providers to input the reporting information and update any documentation that goes along with their submission, and put in their attestation and submit the report. The DOB enforcement communications will also happen through this portal, so you will receive notification from the portal automatically. Okay, so moving into Article 321 compliance pathways. As mentioned, there are that second pathway is for rent regulated and accommodations and houses of worship. The first pathway would be for you to demonstrate that your building is meeting the 2030 limits now, which are of course stricter. And the second pathway is that you would follow the prescriptive energy conservation measures, and there are 13 measures, and we'll go into that in the next slide. This one-time Article 321 compliance report is due by May 1st, 2025, pending any deadline extensions that might be granted. A building that loses its Article 321 eligibility may become subject to Article 320 at a later time if it changes out of that pathway. So these are the 13 prescriptive energy conservation measures. The highlighted ones are the ones that require documentation, and those are the ones for which the templates are already on our website, and you can take a look at what you would need to be documenting for each of those four. And what this is showing you is for the type of heating system you have, which prescriptive energy conservation measure would be applicable. And these are the templates that I mentioned. Again, they are on our website, so you can take a look at that. So for any of you who are asking, how do we report for these PECMs, that is how you will be reporting for them. For houses of worship, the definition is a main use or dominant occupancy is classified as occupancy group A3, religious house of worship. And what that means is that greater than 50% of the building has to be used as assembly space for religious purposes. So we have some idea of which properties are houses of worship, but we may not know all of them. And we may not know that it is actually a house of worship. So we need for a registered design professional to demonstrate and certify that it meets the 50% threshold. And so if you go onto our website, there's an FAQ that documents this. There's also a form that is to be filled out, and that will be posted to our website soon. If you want to take a look at it and you want to request it earlier, you can do that. I have cards here. You can email me, or you can email ghgadmissions@buildings.nyc.gov, and we will get you that form. So similarly to the Article 320 buildings, there's a penalty framework for the Article 321 buildings. If you do not submit your report, you get a $10,000 penalty. You also get another $10,000 penalty for being out of compliance. And that is because if you don't submit your report, we don't know whether you're in compliance or not. So again, get your reports in by May 1st. So again, there are mitigation opportunities in play. Again, unexpected or unforeseeable event, and participation with an eligible energy conservation project, or entering into mediated resolution with the department. So mediated resolution is an option that for building owners that can demonstrate that they are making diligent efforts to comply, but that they just need more time. So there is required documentation that you would have to submit to the department. First is an attestation that the building is out of compliance, that you're either not able to meet the performance pathway, or that you aren't able to complete the prescriptive measures. And for calendar year 2024, you need an energy benchmarking report, local law 84. Even if the Article 321 building is not subject otherwise to local law 84, you would have to prepare one. You also need a work plan that's certified by an RDP or a retro commissioning agent that describes either how you're going to comply with the 2030 emissions by 2030, which would include proposed renovations and how these renovations are going to be financed, or how you will complete the 13 PECMs by December 31st of 2025, including which vendors are responsible.